So welcome back. We're going to start with mutual funds. This is the start of the next unit, and mutual funds is the first topic of discussion in this unit. So the agenda for this presentation is to distinguish between direct and indirect investments, to look at some of the major types of mutual funds, and of course their features, benefits, and weaknesses, and looking at transactions behind some of these mutual funds and measuring their performance. So we will talk about all of those items in detail in this presentation. So first of all, the difference between direct and indirect investments. So direct investments are those investments that most people are accustomed to. So if you would like to buy a real estate property for rental purposes, you would directly buy the property and then rent it out or sell it at a profit later on. When I say direct, I mean you would still probably go through a broker, a real estate agent, but you would own the property yourself. So in other investments such as stocks, you would probably go to an advisor who's also considered a broker and then buy stocks of a company. That is considered direct investments. You are investing directly into the company. The other side of investments are indirect investments. So indirect investments are done through not just advisors but also through intermediary companies. These intermediary companies are now called, for the most part, mutual funds. They can also be pension funds and other types of funds such as insurance funds and so on. But predominantly they are mutual funds. So what's happening is, if you can follow the trail, you can be the investor, you can have an advisor who's also a broker per se, and that advisor may advise you to buy mutual funds or stocks. If that person is buying stocks for you, you are directly investing in a company. If that person is buying mutual funds for you, you are indirectly investing into different companies. Because what the mutual fund does is it actually takes money from all investors that have put money into that mutual fund and then goes out and buys investments. So they would invest in stocks of different companies and bonds of different countries and companies and so on. And then the revenue, the money that they would make from those investments would come and flow through to the mutual fund company. The mutual fund company would be managing your money on your behalf. They would have complete professional management, and of course because of that service they would take a cut from your earnings and then pass along the rest to you. So a mutual fund acts most likely as an intermediary. It is a middle company. It is not a company that you're investing in. It is a company that you're investing with. So you're investing with them. They are now investing for you in other companies, and they are actually directly investing in other companies and countries, and they may buy properties as well. And then from there, any revenue that comes to you, to the mutual fund, is further distributed to you after they have taken their commissions. So mutual funds are very, very popular. You are first of all called a unit holder of a mutual fund, not a shareholder, because a shareholder implies that you have directly invested into a company. So you are called a unit holder, and these companies are entitled to these unit holders are entitled to the mutual fund income that the mutual fund generates. So if you can take a look at the next PowerPoint slide, it gives a pictorial understanding of what has happened in the values of total mutual funds from 1993 to 2003. I know it's a bit outdated, however it shows you that mutual funds have increased in not just size, volume, but also in popularity. And of course things are only popular if they are good for a sustained period of time. So mutual funds have proven to be good, and they've proven to be good for several types of investors. People with low amounts of income or money to invest, capital to invest. If you only have about $10,000, it's very difficult to go and directly invest into different stocks, because chances are by the time you buy one company's stock, you have $0 left. So if you were to put money into a mutual fund, you become a unit holder of a mutual fund, and mutual fund then owns lots of different companies. So that means that you have a $10,000 share into different companies. So you don't have to invest only in one company directly. And that's why the popularity has gained. But the side effect or the weakness is that because these people who are managing your money are well qualified, professional fund managers and professional financial analysts, they excuse me, they have to take salaries and of course the company costs to run. So the share that they take, the commission they take, can be quite high. It can be 2, 3, 4% of the money that has been invested. So recently, in the last 5, 7 years, a lot of mutual funds have decided to decrease their earnings from these investments because investors have protested, and a lot of them have even taken their money out of the mutual funds because of the increase in the fees. But coming back to mutual funds, so mutual fund is a business, it's a company, it sells units to the public and uses that money that they have collected to invest in securities, in different investments. It basically acts as a conduit for distribution of all the money that's coming back, and it offers the benefits of diversification. So I've explained to you what diversification can be, in the sense that instead of going out and buying 10 different stocks, if you don't have enough money, you would now buy mutual funds and your investment would be diversified. It is also good for seniors who would like to take less risk because they are at their stage of life where they do not want to absorb a lot of risk. It can also be good for people who have a lot of money but would like to further diversify and invest in mutual funds. It does offer the benefit of professional management, which you will not get if you were to invest directly, unless of course you're a professional in this area. So there are several types of mutual funds that we can discuss about, and in this presentation we're going to talk about 9 types of mutual funds. So we'll start off with money market funds. Money market funds are extremely low risk funds. These are mutual funds that invest money in only those kind of investments that give rise to either interest payment or small amounts of dividends. So those are low risk funds. They are low risk investments. They would probably just buy GICs, for example, or put money into savings accounts, and whatever the interest they are generating, they would then pass that along to the mutual fund unit holders. The objectives of money market funds are income and liquidity. So there is small amounts of income that's coming through, but they are also very liquid. It's very, very easy to sell them because the demand for money market mutual funds is very high, and the fact that they're not very risky, you can easily sell them. They are attractive to investors with low risk, and of course that can imply lots and lots of different types of people. It can be young people starting to invest, it can be older people who are retired, and it can also be businesses who are looking at putting money in for 30 days or 60 days so they can earn some interest or some kind of income. Then we have mortgage funds. Mortgage funds are those types of mutual funds that predominantly invest in mortgages. So they act like banks, or they would give money to the banks to invest into mortgages. So mortgages are those types of loans that people receive to buy a house, for example, and the house is on house is a collateral for the company, for the bank that has given you the mortgage. So what happens is they give you an attractive interest rate. So let's say 3.5, 4% interest rate these days, and that is still more than what you would earn if you were to invest into a savings account. So that attractive interest rate then flows through to the mutual fund, and then the mortgage funds, the mutual funds that specialize in mortgage funds, then would translate that money, those incomes, to the unit holders. It is really for those people who are looking for some income, because it generates income on a monthly basis. It is also for those people who are looking at perhaps for more than 4, 5, 10-year terms, so they can invest for a longer period of time. And it is riskier than money market funds. So we've talked a lot about mutual funds. We've gone into distinguished between direct and indirect investing. We've also looked at some of the numbers from 1993 onwards about the mutual fund industry, and we have discussed in detail what a mutual fund is. We have at the end discussed about 2 types of mutual funds. So tomorrow we will start on the from the next slide and finish the presentation on the types of mutual funds. Thank you.